What's up, guys? Welcome to the video. This is ATI Markets. Going to share with you something interesting today. We're going to talk about the rule of 72. This is something that I think a lot of people don't really understand, and it's such an interesting and important concept, and it's such a simple concept that I wish more people knew about it, because once you know about it, it just makes life so much easier. So wait till the end of the video, and I'm going to actually walk you through this calculation that frankly is used by the early retirement and financial independence community as a quick means of evaluating how long it will take you to increase your money and to try to estimate that. And then I'm going to tell you how accurate this calculation is. And then at the end of the video, I'm going to tell you why it's important, and I'm going to show you how that calculation will apply to actual ETFs and stocks on the market. So with that said, thank you for joining me. Please go ahead and gently, very, very gently, just tap that little like button. It'll help the channel out. I'm a noob. I'm a little small channel here, but I know what I'm doing, and I'm going to help you. If you're here along the ride, I'm going to give you information that a lot of the big YouTubers are not going to give you, and I'll tell you why they won't give it to you. The reason they won't give it to you is because a lot of their interests are in promotions and, different things like that. And I'm not saying that I'll never be in that category of, doing promotions or accepting any kind of things like that. But I'll never support any products that I'm not interested in, which I'm noticing more and more of the bigger and more prominent YouTubers are doing. They're accepting promotions that help their channels for products and services in the personal finance and trading world that are not necessarily beneficial and don't have the best quality and sometimes are quite frankly questionable. I'll give you an example of one really quick before we jump into the video, named Webull. I just personally don't like the product. I disagree with the origin of the product, and I'm questioning the overall company in general. That's a separate topic. I'm going to make a video on that altogether. So let's jump into the video. This is really important stuff. Like I said, this is going to save you money, and this is going to help you understand how long it'll take for you to grow your money. So the rule of 72, that's what we're talking about today. You can Google it. You can type it in your iPhone. You can type it in. You can tell Siri, hey, what's the rule of 72? You can say, Alexa, what's 72? Rule of 72. Let's jump in. What is the rule of 72? The rule of 72 is a simple way to determine how long an investment will take to double given a fixed annual rate of interest. Okay? Simple way to determine how long it'll take you to double, basically. So how long will it take you for your Apple shares to double? That's basically what we're doing here. How long will it take you for your house to double in value? Okay? So by dividing 72 by the annual rate of return, investors obtain a rough estimate of how many years, very, very simple, years, it will take for this initial investment to duplicate itself. So basically, how long will it take you to 2x or double or whatever your terminology is? This is the calculation that will do it. But when I was first reading this and I first learned about this calculation, me being the quantitative and calculated individual that I am, I started wondering, is it legit? So let's compare it with actual calculations, with time value calculations, and then compare it to the basic simple rule of 72 calculation. So like I said, let's look at rule of 72 versus actuals. This is something that you have to do often in personal finance and in the finance world in general. You have to look at what your forecast or your prediction is, and then look and compare against actual numbers to see if what you're doing makes sense. And that's what we're going to see right now. Okay, so here you have actual number of years, and then you have difference number of years, and then you have rate of return. So that's the starting point. So what do you expect to earn as a rate of return? So if you expect to return or earn a yield of 2% a year, and you use the rule of 72, it's going to take you 36 years to double your money. So low percentage, the longer the time it takes. And if you use the actual time value calculation, which isn't captured here, but the actual time value calculation will take 35 years to double your money. So the difference is only about 1 year, and that's pretty small. I think we can live with a margin of error about a year or two. But as you go higher to the rate of return, so if you look at, let's say, 72%, and you use the rule of 72, it'll take you roughly about a year to double your money according to the rule of 72, but the actual number of years is 1.28. The difference is only 0.3. But basically, you'll know that within 1.3 years, you'll double your money. But using the rule of 72 doesn't seem to be as accurate on the extreme ends of the calculation. But when you're looking at like the 3% returns and the 9% return and the 12% returns, you see that the calculation is actually pretty spot on and the differences are minimal. So, for example, a more common number is, let's say you earn 7% in your investments over the however many years. It's going to take you 10.3 years to double your money. I think that's powerful stuff right there. So why should you care? I mean, what does this matter to you? Like right now, like you doing your thing, like do you want to go to Macy's today and spend $100? Do you want to buy, $200 of stock? Do you want to buy Apple tomorrow? Do you want to buy the SPY? What are you trying to do? Why should you care? How should you move forward with this information? Okay, so this is going to help you evaluate risk fast. And I'm going to show you exactly how to do that at the end of this video. How to evaluate risk. I'm going to show you what I would do, not what the market gurus tell you, not what people tell you. I'm going to show you what I would do personally to evaluate my risk when I'm activating a new investment. And this is just the technical side of what I'm going to show you. I'm not going to show you the fundamental side, but I'm going to show you how I think about it. And the old saying goes, give a man a fish, feed him for a day. Teach a man to fish, you feed him for life. So how are you going to evaluate risk? By quickly evaluating the percentage rate of return, you are able to determine if the return that you're earning is within risk tolerance. So there's different risk tolerances for different asset classes. For example, a more risky real estate investment might yield you a higher rate of return, but that also means it's either risky or more leveraged, and more leverage is often risky. So that's a way to determine if you're above risk thresholds within that category. So let's say levered returns for a commercial real estate project. Let's just say, and I'm not sure these numbers off the top of my head, but let's say that project is supposed to earn you between 10 to 14% rate of return per year on average based on the entire market average return. But if you're getting sold or someone is selling you or trying to pitch you a project that's 20% rate of return, right away a red flag should be pointing in your head and saying that's well above the reports that I'm reading on what the average numbers would be. So, okay, take a step back. Here's an actual example. So let's say a corporate bond. This is something that you can buy on the market. You can either buy the corporate bond itself or you could buy a corporate bond ETF. Let's just say that it's paying 7 to 8%. And it's an investment grade bond. Investment grade is basically the minimum grade of a product that has a lower credit risk, so a lower risk of default or going out of business. Typically, an investment grade bond might pay you 3 to 4%, sometimes maybe a little bit higher than that. But if it's investment grade, it's usually within that kind of range. Like I said, I'm not going to give you the exact numbers, but I'm going to give you the idea. And the idea is if you see a corporate investment grade bond suddenly paying you 7 to 8%, something is going on. You need to dig into it further. What's going on with that company? Take a step back, do some research, analyze the company, analyze the news, analyze the filings, see what's going on. Maybe they're potentially, not able to pay their obligations. Maybe they're deciding on taking on riskier ventures, and therefore the debt markets have therefore sold off the bond, and the bond price is now lower, but the yield is higher. So you, by buying it, you take on more risk, but you earn a higher rate of return. But you now have a higher default risk. And there's analysis on that in separate reports. I'll probably get into that much deeper in a different video. That's a whole animal in itself. I could talk about that for hours, but we're trying to keep it simple today. So, okay, let's review risk. Then decide if the investment is appropriate. Okay, so when you decide on the new investment, the same basic idea can expand to other return calculations. Just like I told you, you want to think about, hey, how long is this going to take me to double my money? Is it 3 years? Is it 5 years? Is it 10 years? How long? And this can also help you get to retirement targets. Let's say you have a retirement target of $1 million and you have $250,000 right now, and it's going to take you 10 years to double your money. Well, in 10 years, you'll have $500,000 pretty much based on what your asset allocations are and based on what your expected rate of return is. So then you know, okay, well, from that point on, it should take you another 10 years and you should be at $1 million, right? That's the idea. So let's jump in the lab. Let's go ahead and review actual assets now. So what I'm going to do is something a little fun for this example. So what I want to show you here first is the Investopedia definition of a closed-end fund. But just ignore this. Basically, I'm showing you a couple ETFs that I've personally been invested in and done research with. They're on the riskier side of investments. They pay a high distribution rate, and I'm going to show you just how risky they are by looking at the Morningstar ratings. So first, we're going to look at the PIMCO High Income Fund. It has 4 stars on Morningstar, which is a combination of analytics they use to come up with a category rating. It goes up to 5 stars. So this is a pretty high rated ETF within the category. The distribution rate is 9.46% currently. So that means for every $6 that you invest in PHK, you're going to earn 9.46% rate of return. That's really, really high, like really high. And I'm going to show you why it's high and the risk in a second, and I'm going to compare it against other asset classes. I'm going to show you this other one too, DSL, 7.98%. It's a 1-star fund. It used to be a higher rated fund, but because of the COVID-19 pandemic and the debt market sell-off over the past year, these assets have gone down in value because they're invested in a lot of different things, such as mortgage-backed securities and emerging market bonds and different types of local governments in different countries. They're all over the place. They manage their risk. It's a managed ETF, but it's important to know that they are on the riskier side and they have a portfolio that's managed to be on the riskier side and meet that rate of return. So I analyzed this 2 ways. I first took the 3 funds that I just showed you right now. I'm going to take DSL, Double Income Solutions, and then PHK, PIMCO High Income, and I'm going to compare it against the S&P 500, the SPY. And this first analysis, I'm testing over a 5-year period. So this is essentially an analysis or tool that I go ahead and take a look at to see what the historical returns are on a certain asset or ETF or mutual fund or stock. So DSL, the lowest rated ETF out of the 2 that I showed you, actually has a higher compounded annual growth rate at 6.92% than the other one that's higher rated, PIMCO's fund, which is at compounded annual growth rate of 1.61. The S&P 500 over the past 5 years outperformed these both significantly. You would have made 12.67% by investing in the S&P 500. You made 12.67% annually. So let's do the rule of 72. 72 divided by 12.67. It would have taken you 5.68 years to double your money if you had been invested in the S&P 500 based on the last 5 years of returns. Now let's look at number 2. 72 divided by 6.92. Really, really easy. You see, I just take the 72 divided by the percentage compounded annual growth. For that asset, it would take me 10.4 years, almost double what it takes the S&P 500. So this is important. I'm looking at actual data from the past 5 years and seeing which asset performed better and then coming to a conclusion. Or am I thinking that because these underperformed S&P 500, that now from this point forward, they may outperform? That's another thought process. I'll get into that in a different video, but that's an example. The other one I'm not even going to calculate because it's so low. Let's take a look at the same three funds over a longer period. So these are actually, for some reason, the calculator is not working. But let's go ahead and take a look at Apple, actually, and then just do this, the SPY. I think that'll just be a lot more, just easier for everyone to digest. Okay, so if you had been invested in Apple since 2010, you would have made a compounded annual growth rate of 31.56%, and the S&P 500 you'd have made 13.88%. So 72 divided by 31.56, that means it only took you 2.28 years to double your money in Apple over the past 10 years. So you could potentially have doubled your money close to 3.5 to 4 times there. Let's look at the S&P 500. 72 divided by 13.88. It takes you approximately, according to the rule 72, 5.18 years to double your money. So under that assumption, you'd think that you would have actually doubled your money twice. In this case, you actually doubled your money more than that because of the compounded effect. So when you're looking at this, you have to consider that compounding effect of the interest. So long story short, this gives you a proxy of how to calculate how often your money will double. And that's pretty true here. So you can follow along the chart when you do these types of analyses and basically see that, like portfolio 2, I'm expecting 20,000 in about 5 years, and that's exactly where it doubled right there. So you can see that actually that number actually holds true. If you had invested in SPY in 2010 and then you waited 5 years and you earned 13.88%, you doubled your money in 5 years, which is what we just saw. So altogether, I hope this video was helpful for you. This is the rule of 72, and it's an important and simple concept that not a lot of people know. And I just wanted to get in the lab with you and just go ahead and analyze this. So like I said, this is ATI Markets. Go ahead and leave me some feedback below. Like, comment, subscribe. Tell me what you're thinking. Tell me what you want to know about. Tell me what topics you're interested in. Because I'm a smaller channel, I'll be a lot more intimate with my subscribers. I expect that I won't be able to manage it once the channel grows, but I'll make you a commitment right now that I'll always try to make myself as available as possible to answer questions within the community. So, like I said, thank you so much for joining me. I hope all of you are doing well, and thank you for your support, and be well, everyone.